So by 2030, $100,000 will be equivalent to around 65,000. Effectively, this means that the natural level or percentage-wise average inflation will increase, which is not a surprise. And of course, we're not speaking about the CPI report. We're not talking about the production increase of the inflation. We're talking about the actual inflation that is not calculated based on the real basket of goods and services that people truly buy on a daily basis. So what this even means for you, personally and professionally? Well, if you have a business, you have to raise prices. Raising prices is painful. A lot of clients will stop using your service or stop buying your product. They will look alternatives. Recent studies that were published last month indicate that when the grocery prices increase, all the major shoppers, people who usually shop at least once a week in the grocery store, right, they stop buying branded stuff. They stop buying the brands of the grocery chain. For example, if before you used to buy some French provolone cheese, you used to buy, let's say, Italian, whatever, tomatoes. Now people go and buy the local Walmart brand, Target brand, local Target Trader Joe brand, right? So people scale down. People not stop buying what they need to buy, the necessities, but people downgrade the brand. So how do you actually prevent this happening with your company? By 2030, right? You don't want people to start buying someone who is undercutting your prices, right? You don't want your brand to essentially downfall because of lack of sales. Well, how you fix this is you start raising the prices little by little from now. So effectively you can calculate how much the percentage or the actual price of you keeping the same margins of your goods and services will be by 2030. Let's say, for example, now you operate on 40% profit margin. Well, when you adjust the average percentage inflation, you will understand that the buying power of your 100,000 revenue times whatever revenue you are making or you'll be making, your projection, of course, with estimated average growth. I'm not talking about if you're making 1 million for you to expect to make $50 million in whatever 4 years or 3 years. So when you actually get the average percentage inflation and when you compute the projected earnings, you will get the prices that you should set for every single year. Little increase. Maybe you will have to increase the prices every quarter, which means 4 times a year you will increase the prices, which basically means that every 4 years you have to meet this average percentage increase quota. Not to make more money, just to keep making the same margins. Understood? Not many business owners understand that, because this is not the basic economics. Basic economics is just following whatever the Bureau of Labor Statistics reports. People take their word as a nominal of value and truth. And I said, the models that they're using are not accurate because they don't really compute what people actually buy and sell. True inflation only measures on the individual basis. If I buy 10 products or services every single week, and these 10 product services are not included in the basket that Bureau of Labor Statistics measure, they don't really measure my personal inflation that I've got on products and services I buy or purchase. So it's all random. In most cases, it's pretty irrelevant. So here is how we're going to approach the situation in your business. You are going to compute your potential revenue, and you're going to compute your prices adjusted with inflation. You're going to take the average percentage inflation. You're going to get any number between, I would say, 4 to 6%, because we're printing more money right now. Federal Reserve is printing more money right now. So you need to understand that when you take this average percentage interest between 4 to 6%, and you apply this spread out through the next 4 years, you will get the number that you should actually use, increasing the prices every quarter or every couple of months until the year of 2030. So when the year 2030 comes, you can keep your clients you can keep your revenue. Your buying power will be the same because you adjusted the prices with inflation, and you effectively didn't lose any clients because people used to having these small price bumps here and there. What will happen with other companies? They will be forced to increase the prices overnight. So what is going to happen? Well, when you increase the prices overnight, everyone will churn. Over 60% of the clients will churn. If we used to charge, let's say $10, and you wake up in your business and you understand the inflation has rose for the last 4 years, let's say 12%, and you have to increase the prices of your goods and services with another $6 or $7, you do understand no one was going to buy. Maybe it's very slim, small percentile of people who really do not make any difference, we don't see any difference between $10 and $19 or $10 and $18 will keep buying. But this won't be enough for you to cover the cost in the labor and whatever, right? The math will not matter at this very point. So after we solve this issue for your business, how you're going to adapt your personal spending, your personal expenditures? Well, presumably everything that you usually buy, clothes, accessories, vacations, absolutely everything will be more expensive. There's no world where things are going to get cheaper, especially on the commodity side. Commodity side is everything that is actually physical. Hats, sunglasses, clothes, merch, whatever. Why? Well, so far people had money. Inflation was kind of in control. But now with all the war spending, the inflation has gone out of control. So printing more money was required for keeping up with the war activities. So why this changed the math? Well, when everything got so expensive and when the money started losing faster and faster their value, people stopped buying as much as merchandise. So all these fast fashion, cheap shirts, cheap pants, they stopped working because they don't produce. The company cannot use the economy of scale anymore. So the company cannot produce 100,000 t-shirts a day for a cost basis of 74 cents, right? So if they cannot produce 100,000 shirts, do the math. They have to produce 50,000 shirts. So the cost jumps double. So if they produce 74 cents a shirt, and now if they can produce only 50,000, so the cost basis jumps double. So 150 a shirt. So they cannot sell the cheap fast fashion anymore, right? Do the math. This is just figuratively speaking. We're not, using hardcore data. But just on the numbers, this is exactly how it works. And this is why the economy of scale for all these fast fashion brands and even the luxury brands which rely on premium will not be as effective. I'm expecting to see, listen up, this is a very large speculation, but I'm expecting to see more and more people actually to start stocking up luxurious brands. I'm talking about high quality premium. I'm talking about cashmere coats. I'm talking about baby alpaca coats. I'm talking about probably some of these females purses that are limited edition. I'm expecting people to actually store value and exchange their money for some of these physical limited edition in high demand goods, because this is definitely some way of, I would say, leverage and hedge against the market uncertainty. Considering the AI bubble is still 50-50. You still know, is the market going to bust or is the market going to continue running, right? We still have more tech companies report earnings later this month. So pay very close attention. This is my largest and biggest speculation. I personally have purchased a couple of, I would say, relatively expensive clothing. Not for myself, I just exchanged. I sold a bunch of other, mid-tier brands and bought one very, very high-tier brand. Not for me wearing it on the streets, but me just keeping it as investment, because I know at any point in time I can just liquidate the item and extract much more cash. What I'm saying, let me simplify. Let's say I have 3 different P codes, right? Or just random brands. Let's say some mid-tier brands, whatever. I sold each one of them, and with the purchase, with the budget, selling these 3 different P codes, I bought, European code. Something like this. Exceptional difference between the liquidity of these expensive brands holds value, and it's easily, you can go and, I can go tomorrow and drop the code at the pawn shop, right? And I can get 400, 500, 600 cash on hand. You cannot do this same thing with mid-tier brands. No one cares. Yeah, cool jacket, man. Yeah, I don't want to buy it. Because there is something else, except the intrinsic value. There is something attached to the longevity of the item. It's not just quality, it's not just brand, it's the value proposition. So keep this in mind. This is probably one of the biggest speculation, but something to keep in mind, okay?
This is exactly what people said who lost money on silver during the 2000s run-up of the silver. People were frustrated, people were extremely angry that they purchased at the top. Later, after they call it a bubble, a lot of people actually said it's actually a scam. Read very carefully. Based on the market analysis, people who purchased at the absolute top of the silver at this time, around 2000s, they had to hold over 20 years just to break even last year. Pay very close attention. Based on market analysis from the era, people who bought at these particular prices were experiencing excessive frustration at the times of irrational sentiment-driven nature of the market rather than just supply issues. While some believed in a long-term value, this sounds familiar. A lot of people now in the comments, we're here for the long run. While some believe it's a long-term investment, others face losses from the rapid price crash. What about sentiment? Well, back then the sentiment was, of course, over the supply. Everyone was bullish. No one cared about the actual intrinsic value of the silver and long-term price action. Observers noted that in the early 2000s, like the dot-com bubble, silver price movements were driven heavily by investor feelings and speculative frothy sentiment. Same like now. People are buying because other people are buying. Unwarranted. I'm here to warn you, okay? It's not gonna be like the other time. Investors often found themselves in position where they had bought into a runaway speculative frenzy that was not supposed by fundamental supply changes. Guys, when there is no fundamental at the exit of anything that you're buying on the equity markets, on the precious metal market or crypto markets, the exit is usually always the same. People got rinsed. And in the case with silver, like I said, how would you feel if you have to wait 20 years, your money locked on losses just to break even, not to make money? I guarantee you there will be, or there had been, people who last year just broke even, waiting this 20-year period, and they didn't even want to think, oh, it might go hard, I might actually make some money. No, let me just sell. Let me just, forget about it. I've been waiting 20 years. I don't want to hear silver anymore, okay? Look at this. Volatility and the crashes. Even with the potential for long-term growth, something that a lot of people now are buying into, the main reason for it, those holding silver in the 2000s faced significant volatility, such as major, rapid, and historic crash. Of course, there was frustration with physical disconnect. Some investors, particularly when holding silver trust during the volatile times, expressed frustration regarding the disconnect between the paper silver prices and the actual physical supply of the silver, which is happening as well right now. If you go and look at the exchanges, buying the actual futures or actual silver on the equity markets versus holding the actual assets, physical gold and silver, have different prices, have different value, right? And this is the same frustration. Why? Because the game is always the same, but the newcomers don't know this, so they're gonna get rinsed again. Pay very close attention. In summary, those who lost money often cited in irrational bubble-like behavior of the market and high risk speculative nature of trading silver during this period. Again, you need to understand what is happening by looking what actually happened, because the same people are trading the same stuff and they're buying into the same stuff by looking at hype, irrational thinking, sentiment, which is oversupply, which means that the sentiment is overtaking the supply, the actual fundamental value. If you're trading, you know that if you look at the RSI index, right, it shows you oversold, overbought, and you have the fair value, which is the fair market evaluation of the asset. People are not looking at any of these. People are just looking, okay, is it up? And people are always willing to buy when it's up. And most of them are willing to sell when it's red, which is completely opposite, right? It almost feels like you're willing to buy your home when your home, like, it's $150,000 more expensive than last month, right? But if your home that you're planning to buy, it's $150,000 lower, you're not interested in buying, because you were thinking, first of all, it might go lower, and second, you might be thinking, oh, it might actually not be a good deal. If the price decreases, if I buy it, it will go lower. So it's a two-way think about it, right? First of all, you want to go lower so you can buy it, but you don't want to go lower because it might actually be a bad deal and it will depreciate, or it might depreciate even lower after you purchase it. So it's crazy checkmate scenario. And of course, it all ends up with volatility, crash, and frustration. Same three scenarios. And this is not me making up anything. I just went on Google and I just typed, what did the people who lost money trading, holding silver in the crash of 2000 said about the crash? That's it. I just asked Google for summary. I'm not making up anything, okay? This is proven by the facts. As you can see over here, everything comes from a particular link with comments, summary, articles from 2000. And people got rinsed. Imagine what they came home, you know, what they said to your wife, you know, it's down. We put 100K, now it's 20K, it's 30K. I'm sorry, I apologize, right? They have no explanation. You know why they don't have explanation? Because they don't have reason to buy into it in the first place. When you have a thesis and when you have a sophisticated framework to define your thesis, right? Why you buy Nvidia? You have a sophisticated explanation. Nvidia supports the AI infrastructure, which AI infrastructure cannot exist without Nvidia. Well, Nvidia presents a bottleneck through the industry that is evolving and growing on the institutional or individual level. So this is how you build your thesis. This is how you understand the main reason why you buy into something. If you stop some of these precious metals bulls on the market and ask them, why did you buy? Now or before, most people have zero answer. Zero answer. They will most likely pull out their phone and they're gonna show you some video or something or someone that told them to do so. The question is, when everything crashes down, right? What they're gonna say? Are they gonna go again and back and look into this person, ask for a question, for advice? No. Because it is not bad to lose your money investing if you really put up the time and work and you predicted something is going to happen. You may be wrong, but you lost or you made money based on your own knowledge and expertise. It almost feels like an achievement because you put up the work, you test something with your own money. You don't use leverage, you don't use someone else's money, you don't use your friend's money, you don't listen to somebody else on the street. You just took your own money, did your own research and due diligence, and then you waited to see, is it gonna be a success or is it going to be a failure? This is how, you know, the man should supposed to approach everything that appears to be an opportunity, or it might end up being a trap. Gold and silver prices crash in historic sell-off. Gold prices to hit new lows of $1,450 and silver to go down to as low as $12 per ounce. Well, this is how you print back holders in real time, but we already discussed this in the previous video. People already pissed off, probably crying their eyes out. They borrow money, they use leverage. But who I am to argue with the hype boys on the markets? Let's stick with the details. So the spot prices of silver down 28%. 28%, what a sell-off. My little free end, and people were making the case that the precious metals are not stocks, are not crypto, are not the US dollar. They're valuable, they are not fluctuating, they couldn't go down. Nonsense. So the prices was hovering around $83, currently it's even lower per ounce. Not a surprise, you don't have to be, excited because things are going to get even worse. According to the summary over here from the X, this is, or this was, and most likely it's not going to be, the worst single day drop since 1980s. And all the backholders of silver who held over 20 years just to break even, already having a small reminiscence. They already remember that, oh my gosh, last time what happened, it might happen again. And believe me, if these people went through this particular crash, they have to hold their silver bags for 20 plus years just to break even. They're going to be the first ones selling right now, seeing weakness on the market, not waiting another 20 years to break even again, right? Forget about what Peter Schiff and the people like Peter Schiff saying that this is a buying opportunity, this is that. Same thing what Robert Kiyosaki was mentioning, that this is going to be the biggest crash of our lifetime, and this and that, and buy Bitcoin. And what was it, November or December, somebody reported that he sold some Bitcoin. Don't ask me why, ask him why. Also over here, the sell-off was followed by President Trump's nomination for the Fed, which was Kevin Walsh. Which, why would that be even the case? Why people be reacting like this? Well, this is acting like this because the US dollar will again go back to the previous levels and will sacrifice all the gold and precious metals price action because the dollar will regain its power. What a bad news for gold and silver investors, but even worse news for BRICS, which in fact launched just 2 days ago their new currency called UNIT. If you're not following the international economic news, I honestly believe it will be very hard for you to follow up and really match the pieces, but this is a very strong checkmate move from President Trump because now he's seeing what is happening with BRICS, and BRICS was trying to capitalize on the weak dollar, trying to capitalize on their gold and silver reserves, trying to build their wealth, country wealth, and their hedge. Because, let me explain, the new currency of BRICS called UNIT is 50% backed with gold and 50% is backed by basket of currencies of the countries in BRICS, which trying to make it less volatile, trying to make it in some form or shape at least copycat of the early dollar gold backing before or after Bretton Woods, which, don't take my word for it, it most likely won't work. But anyway, let's go back to the facts. Kevin Walsh is very, very bullish on the dollar, and Kevin Walsh will create much more value and much more contribution and intrinsic value for the transacting in US dollar. Will most likely reduce the Fed exposure to gold and silver, will most likely create a long-term cooling off the precious metals, and this also might trigger actual oil prices to hit new lows. Just wait for it. Again, the losses today alone totaled $3 trillion to $7 trillion across both metals alone. We're not even looking into the smaller precious metals market caps in the sell-offs like copper or palladium. Things are gonna get even worse over there. Not to mention the liquidity over there is much worse. So this simply meant that there's a very high chance a lot of people who tried to sell weren't able to get filled on the prices they're trying to sell. And again, if you if you have a basket of precious metals, if your precious metals bull, someone that is forever and in the future is only going to be the precious metals, forget about stock market, you do understand that these people will be panic selling first of all this type of precious metals, the ones that with the lowest liquidity, the ones that is very hard to exit. It's easy to enter, everyone is willing to sell you their palladium, their copper, but it's very hard to sell. Why? Because there's not a matching buy order on the opposite side of the equation, and also there is no market making on the precious metals. So there's no a market maker who is forced to buy when no one wants to buy, or forced to sell when no one wants to sell. Again, people don't want to listen. People are extremely arrogant. They argue. I've seen people arguing with Dalio, with Warren Buffett. I've seen people, especially in these financial news channels, having zero achievements in any financial markets, and arguing with these legends, right? So I'm not surprised people will still be arrogant and still will be claiming that they know more about the market, they know more about gold, they know more about silver, and they never get rich. I don't know how this works. If you know more than the biggest OGs, if you know more than the billionaires, if you know more than individuals from Wall Street or financial markets or private equity funds, well, then you most likely has to be wealthier than them, but you are not. So I guess this destroys your thesis in real time. Anyway, crypto market also suffer. We have to put everything on the table, right? We're not excluding the Bitcoin sell-off below 82,000, but that's not a news. Remember, we had Bitcoin around 80,000 in November sell-off. I made a special recap video where in 2025 we only had 3 good months for crypto. It was March, it was August, and it was September, and everything else was complete garbage. Sell-offs, chop, sell-offs, and completely die out. And now we're having this,